reading P&Ls, profit and loss statements like the underwriters, like the banks, how to not create questions unnecessarily, because we're always storytelling. And each of these financials, and the interim financials particularly, tell an important story. So profit and loss statement. This has the revenue, the expenses, and the net income or net loss. That's the statement that it indicates how's the health of the business. Are you profitable? Are you not profitable? How's cost of goods sold? Do you have interest expense? Are you paying yourself officer compensation? So how to ensure that you don't create questions. Don't have weird categories that not anyone reading it, especially a bank, would understand, like ask my accountant is one I want to mention. I've seen this time and time again. It's a categorization that an accountant will put as a placeholder. That's not submission ready to a bank. So you're going to review the P&L yourself, even though you do not need to be an analyst, a banker, a financial expert. You just need to read it down and you can ask questions. That's why you pay your CPA or your tax preparer. You're allowed to ask questions. And just because you have an excerpt that's an output from QuickBooks doesn't mean it's right the first time, that every categorization is accurate. So you want to do that audit. Hopefully you're working with a financial professional and a company that helps you prepare for being eligible and makes this analysis too, to be your final set of pre-eyes before you use your first shot at a first impression. So reading a P&L like a bank, you want to see, do you have a net income? You should be showing a net income, hopefully, if business is strong. And are you using the add backs that all institutions are going to look at? There's some, like officer compensation, not every bank and institution is going to add that back, but every other bank and lender in almost every context, I can't say a universal yes, but almost always, interest and depreciation are add backs. So you're going to look at the interest expense line on them. And if you have loans, you should have interest. They're not all 0%. And you need to understand and help have this bookkeeper, accountant, CPA to itemize and appropriate interest accurately. And that's what their job is, to assist you. That's why you pay them. So very important, interest is listed, depreciation, if applicable, also listed. At times, tax preparers and accountant CPAs, they'll wait till year end for the reconciliation. Why is that? Because no tax liability is born on an interim P&L. You're not reporting to the IRS. So for an accountant, in their perspective, it's just kind of a bill of health. But when you're applying for bank financing, that's the difference between yes and no. Almost always is, are you using the add backs and are you itemizing and calculating interest accurately if you're doing a refinance? That is the number one impediment to application approval, is using interest appropriately, officer compensation appropriately. Those are the two. And at times, of course, year-end depreciation, because it's an expense, if you introduce depreciation, you add it in when it wasn't already there, then it brings you're neutral, because you've added $50,000 in expense, you were at a net income of $50,000, now you're at break even, you add it back, you're where you started. But if depreciation's in the wrong category, which happens, and ends up, just call it cost of goods sold, somehow, some way, in the wrong category, which happens, you gotta ask your CPA and accountant about it, then you have just lost what could be profitability, which illustrates your ability to service a loan for repayment ability, debt service coverage. So reading the P&L, like the institution, like the bank, is, am I showing a net income or a net loss? If I have a net loss, do I have interest depreciation? Am I showing my officer salary, my officer wages, my owner salary? 3 different ways to say it. But officer compensation, that's the official term off of most tax returns, and you want to have that separated from general salaries and wages, because if it's not, a bank will not add it back. Full stop. It's just how it is, unfortunately. So we've got to set them up for success, for underwriting success, which sets you up for underwriting success. So not having nondescript categories or descript categories that don't make sense, not anything that would create questions, you want to alleviate. And if there are maybe a trend issue that you're showing that you already know, you want to front run proactively and point it out and have an explanation for it. Yes, we slightly reduced revenue on the year ends last year in 2025, and it's because we stopped working with a particular client that didn't have a great ROI, it wasn't high margin, and so we've, as you can see, improved our margins, although there's a slight reduction in revenue. That's a fair narrative, especially if debt service coverage is still there. So understanding, you're reading it like the bank, people that are looking for reasons to effectively say no, you do not want to give them and empower them with any reason to reject your application. So read it down yourself first, work with a professional who truly understands finance and reporting in a banking context, and of course, this is what we apply and provide in that eligibility report for you. That's a key point of this, and the difference between a yes and no, time and time again.